Hey guys, thanks for joining us. Welcome to the Continuous Learning Library. This is a place where I want to be able to teach you guys a lot of different things about the markets in general. Okay. Today, I want to talk about stock splits. Okay? There's been a recent announcement of some very high profile companies doing stock splits. And I want to make sure you guys are fully aware of the benefits and what it entails. So we're talking about Tesla and Apple in the recent announcement. So I want to just talk about real quick, what is a stock split? I want to talk about why do a stock split and how can it benefit me? And I have something in bold, invest and let your money work. What I might mean by that right there is once you invest in these companies that may be doing a stock split, do nothing, okay? There's absolutely nothing to do to get involved with it. Your money is working, it's part of a process. And over a period of time, we're hoping that through the stock splits, dividend payments, and things of that nature, it's going to compound and just pay you or give you a higher and higher return year over year. Okay. All right. So, what is a stock split? I want to just quickly navigate through what a stock split is, as simple as I can make it. All right, guys. Now, I'm going to draw a $100 bill. Okay. I thought about how I want to explain this to everybody. A $100 bill. Okay. Now, I'm going to draw 5 20s. 1, 2, 3, 4, 5. This is a $20 bill. Okay. 20, 20, 20. All right. Simple as I can make this. This is, my friends, a stock split. You got one share versus 5 shares. Okay. Now, how much is the one share? The value is $100. How much is the 5 shares? The value, $100. That is a clean stock split. So when you hear the term stock split, understand you will have an increased number of shares, but the value of the increased number of shares is going to equal to the one share that you had before. Okay. Now, what does this mean as far as your portfolio build out? What are the benefits of this, and why even do this? Well, there are some companies out there that are so expensive to trade that they say, hey, the entry point, we talk about entry points in our foundationals course. The entry point is such that many people can't even get into the stock. Now I'm thinking about the stock screeners that I create in the foundations course, where I say, hey, give me the Fortune 500s under $50. Yeah, those companies are under 50, but it does not necessarily mean that they're going to be any more valuable than the companies that are above $50. We do that because of what? Entry point into some of those stocks. Sometimes an entry point is better when you can afford them, right? So I think about Amazon, think about Tesla, Apple. Those entry points are very expensive. And that is regardless of the analysis that we do on some of those stocks. So if we analyze Apple and say, oh yeah, it's a great company. Well, you got to come up with right now close to $500 to get in. That's not feasible or obtainable for many people, including their own employees. I think Tesla's reason for splitting is they said, hey, my frontline employees, if they wanted to buy one share, they can't even do it. So they do what they call a stock split. Now, how can this benefit us, right? Now, all stocks are about supply and demand, the number of shares and the demand for those shares. If this stock split occurs, 100, one share is 100, 5 shares is 20, all of a sudden, people who could not afford the $100 share are going to rush to the $20 share. And this may happen with Tesla and Apple as well. You guys will be able to see that here in a short time. But at a $20 entry point, you're going to get new investors, right? To say, hey, I want to get some. Even though they're buying, when I say diluted shares, they're buying shares that are diluted, so to speak, in value, because in actuality, that one share is not equivalent to this one share. This one share is equivalent to 1/5 of that one share. That makes sense. So they're going to buy, new investors are going to come, even though they're coming at a diluted price. It's going to be so many more new investors that it's going to put pressure on that $20 price and maybe push it upwards. Okay. So now you have 5 shares, and if all 5 goes up, what, $2 a share? Okay, that's a $10 premium on top of that stock there. That's what in actuality what happens. And over time, these shares, because it's such a good company, are going to increase time after time after time, which is going to say now we're at a point where we got 5 shares that are moving their way, maybe potentially back up to 100, where we had one share that was $100. That's how you make money off of a stock split. Fortune 500s do this. As a matter of fact, when we build out our portfolio, I talk about that category, the Fortune 500 category, and I talk about the need to have our money there. And I also say, hey, over a period of time, this is what's going to happen. So if you got money working in these Fortune 500 companies, 1, 3, 5 years, you're going to experience some of this, and it's going to build, and the appreciation is going to compound year after year after year. That's why I appreciate and I emphasize investing in Fortune 500 companies, the majority of your portfolio. We do that. So hopefully you guys are following that model as well. Okay. Now, sometimes you will see something called a reverse stock split. Now, what does that mean? A reverse stock split is where it's the exact opposite of what we're doing. They may have 5 shares that's trading for $20 a share. They say, hey, we're going to do a 5-to-1 reverse. We want to take some of our shares off the market. They're simply going to give you $100 for 5 shares. And they're going to say, you now have 1 share. Your portfolio balance is still going to say $100, okay? But you're going to have 1 share as opposed to 5. Why would companies do that? Well, if a company, one extreme example is, okay, there is a minimum that your stock price has to be on occasion, on the NASDAQ and some of these exchanges. When I say minimum, the dollar amount. When they see that being threatened, they say, hey, we're going to take some shares off the market to increase our stock price just so the physical stock price will be higher. The value of the company has not changed. They're just saying instead of having 5 shares out there, we got 1 share out there for every 5. So that is one reason why they may do a reverse stock split. Another reason, they just want their stock price to be higher. Just from an aesthetic standpoint, they say, hey, we just want our stock prices to look better. And they will actually do a reverse stock split. Or they want to just take some shares off the market. That's called a float. They want to have less shares on the market. When you have less shares, they tend to, if the volume increase, the price point goes up a lot higher, quicker. So that's all about manipulating, or I shouldn't use the word manipulate, but moving their stock price higher in another means other than the general way of trying to appreciate your stock. All right. So hopefully I've cleared a few things up for you guys. This is an example of what we do in the continuous library. And those of you who are in the continuous library, be on the lookout for many videos, like many additional videos out there. And remember, guys, invest and let your money work for you. Okay. Thank you, guys.